I think that's probably one of the deepest things we know about money is it really doesn't matter. Okay, what matters is what you do with it. What matters is what you consume with it. Okay, so welcome back. This is lecture number 7. We're moving into a new area today. The trick will be to use tools and models that we've already developed in previous lectures to help us understand this very important phenomenon, money. Okay, so we'll start thinking about the long run, and by the end of the next 3 weeks, we'll be very much in the current situation. We'll be thinking about the short run, medium run, and we'll start to move towards macroeconomic models that many of you learned about when you were undergraduates. Okay, so this is an important lecture, sort of a change of scenery, as it were. So we'll review last time. There were a couple of things that didn't work out because of the technical problems, but I think I've got it under control now. But I'll review that. I urge you very strongly to go to the section today, tomorrow, and the day, the 2 sections tomorrow. And there will be an extra pair of lectures because the failure of the recorder system means we have to re-tape the lectures, and I want to put them on tape. I also found a few typos. With the help of a student, we found some typos in the lecture notes, the slides that I replaced. So it might be a good idea to come to that. And if you want, we'll make an announcement. It'll probably be on Wednesday. I may actually ask Andreas to shift one of his sections around so you can all come if you want. But it'll have to be in this room. We have to find the room, a time when the room is free. Okay, so I'd like to begin talking about the Ramsey model. One last time, I'd like to tell you it's called in the modern literature, it's now called the Ramsey-Cass-Koopmans model. It's sort of a hat tip to 2 other people who were very prominent in growth theory who also extended this model and made it more modern. So David Cass and Jalings Koopmans in the 1960s were influential in extending this model, 50s and 60s, were influential in extending this model to many different applications. And you'll see that you can't get rid of the Ramsey-Cass-Koopmans model. It's always there. And believe me, the version that you're playing with and using the arrows is a trick. It's to make it easier for you. I think Andreas already intimated that it can be made much more complicated. We can actually try to describe the dynamics more carefully. But often, even with the assumption of specific functional forms, it's not possible to solve those differential equation systems, so you have to use numerical methods anyway. So you always have to go back to the computer, right? So and eventually in macro, you'll see that's our kind of a problem now. I mean, it used to be so much fun to have an ISLM model, and you could just tell everybody what's going on, but it's not quite so simple anymore. If you want to capture the dynamics in a sensible way, you really do have to use the computer and have a model that describes the dynamics exactly, okay? And then, of course, that means the model is opening up its flank for attack, because some models don't do very well on the dynamic side. Okay, so that's the dilemma we face. Okay, I'd like to start by talking about, in this brave new world of money, I'd like to talk about what money is, basic ideas, and competing models that are used to introduce it into macro, because inherently money doesn't have any value. We've moved away from gold and silver. We've moved towards using pieces of paper that are hard to replicate, to forge, to counterfeit, but also we're using electronic forms of money, credit and debit, ledger entries at banks, at credit institutions, and even entered in the blockchain. I mean, this is a very new way of thinking about money, but there's no reason to discount it. We need to understand why it's definitely a candidate for money. And to do that, we'll have to talk about models that explain why people use money in the ways they do, okay? And then I'm going to try to make some really simple appeals to intuition. And a robust prediction of all monetary models is that prices in terms of the monetary unit and the quantity of the monetary unit are highly correlated. They're not perfectly correlated, and there are other factors. There is no single monocausal explanation of inflation, and you should never believe that there is. Okay, there are many different things, and that's what economics is supposed to deliver us, a framework for thinking about multi-causality, but still being able to sort it out and test it. Again, it has to be testable. Remember, falsifiable hypotheses. Okay, so let's get into the last lecture again. We thought about the phase diagram as a way of operationalizing this Ramsey-Cass-Koopmans model, thinking about changes, absolute changes per unit time as a function of the state variables at a point in time. And then if you have as many variables as you have equations, you can actually characterize the dynamics, and maybe the dynamics are unique, and maybe there's a path that leads to a steady state. And that's kind of what we did with the state space representation, phase diagram representation, if you will. And then we looked at how the central planner would actually control consumption and thereby control the path of capital via investment to reach her most preferred solution, to make everyone as well off as possible. Okay? And then we asked the question whether a decentralized market economy where people behave as if they were dynasties could replicate that, and under what conditions would the replication occur. And that's another way of talking about the first welfare theorem, or its converse, the second welfare theorem, which means asking if I have identified an optimum not just at one point in time, but throughout time, can the market reproduce that as a decentralized outcome? And Arrow and DeBrew, I'll show you in a second, repeat it, showed this is possible. Okay, so we looked at this analog Ramsey economy, and the cool thing about the Ramsey decentralized economy, if you like, as expressed by Ben-Assi in his book, is that people don't have any clue about a central planner. They're just doing what they do when they go to the store and they buy their groceries and they plan their savings and plan their life. And in this very simple model, the economic optimum is actually reachable as long as certain conditions are met. Okay, and again, the economic intuition for the decentralized optimum is that the individual household faces a wage and faces a path of wages, not just a current wage, but a path of wages, not just a current rental rate for capital that the household can use to save and dissave, but also a path. So given those paths, what is the optimal policy? And we can use the same tool of the Hamiltonian function and the Pontryagin's maximum principle to actually derive the right choice. Okay, and that right choice actually corresponds identically to the planners in a certain number of cases, in a certain special set of circumstances. I'll repeat that again. And again, these are names that have been forgotten by many economists, but not by all. It's Ken Arrow and Gérard Debreu in the 1950s wrote independently these contributions and were awarded appropriately the Nobel Prize for these contributions early on, and we still understand, and most of us should understand them if we call ourselves economists. We have to understand that you can't just preach free markets, you have to understand what you're talking about, okay? Under certain conditions, the preaching just doesn't suffice. The markets don't deliver the best. You know, it's obvious for most of us, we have externalities, we have increasing returns to scale, natural monopolies, we have Amazon, you know, we have big players that control things. All these things can make the welfare properties of the decentralized economy break down. Okay? And we also talked about some unfinished business. So let me just launch right into it. There are two guys again, Arrow and Debreu, and Arrow is now deceased, 2017. These guys proved independently using very, very intricate mathematics to show that the price vector that basically comes out of a decentralized, you know, with heterogeneous agents and the like, you can't do better than the decentralized market outcome under certain conditions, okay? And then the reverse engineering problem is a little bit harder. So, you know, we started with Ramsey. Actually, Ramsey is a normative question, so we solved the optimum, and then we asked, well, is it possible for the market to somehow decentralize this outcome? And the answer is yes, if you're allowed to distribute wealth at T0 at the right way. And since everyone's the same, you don't have to do this. It's just a single representative agent. So this is a really easy one. But if you're into this and you do micro, general equilibrium theory, it's actually quite tricky. It's even trickier if you have lots and lots of goods. Okay, we only have one good in time t. So you think we have an infinity of goods, consumption goods at each point in time. And in the Arrow-Debreu world, each one of those is a different good. You index each good by the time, the place, and the date, or and the good itself, whether it's green or yellow, or whatever. Here we just have consumption, so it's fairly simple. But it's more complicated if you have different dimensions, in sort of an infinite, at any point in time you have an infinite spectrum of goods. You can have goods with a shade of blue and a shade of green, and then you have to figure out, well, is it still possible to decentralize that optimum? And it turns out that Andrea Mascalel and others have shown this is indeed the case. Okay, but that's not my course. My course is about macro. So, but again, this is about trying to rationalize Adam Smith. Adam Smith had the intuition for this in 1776 when he wrote The Wealth of Nations. And he said, basically, the market delivers a good thing, not because we like markets or we like people to get rich through markets, but because people acting in their own self-interest will lead to an allocation that actually provides the most welfare for the most people. And proving that is difficult. And actually being honest about it and showing when it doesn't work is also difficult. Okay, so the conditions should be clear to you. We've assumed constant returns to scale. You can have decreasing returns to scale, but you can't have increasing returns to scale. You need to have perfect competition. So the firms that are acting can't be acting in a way that they know they can influence the price by their action. They have to be price takers. And we need full information by the agents. We have to have complete markets. Okay, so these are all sort of conditions that we need. And again, that means that we should work for competition. If we want the market to survive as a method of delivering the goods to you and me, we should work on things like more competition rather than less. We should try to recognize natural monopolies and do something about it if they do occur. So if Facebook becomes infinitely big because it's got increasing return on scale, maybe we should provide conditions so other firms can come in and keep Facebook from exploiting the market. These are kind of general, obvious things to think about. These are also important for macro. And you'll see later on we start doing other types of analysis, or maybe you take a monetary theory course, you'll have to think about welfare as the central bank can somehow manipulate it. So that's a first violation of what we're doing here. So you have to be really careful. When the central bank is a separate player, you have to either assume the central bank is maximizing the utility of the agents on behalf of those agents, then it'd be okay. But if the central bank is a bad guy, acting on the behalf of some government or maybe some other government, then you have to worry about that. Okay, policy implications. I told you there would be at least two, and there are just two today, and then we'll move to money. The first one is think about low interest rates given the Ramsey-Cass-Cookman's model. Okay, so I already showed that the decentralization is possible, and under certain conditions, we can think of agents taking the user rate of capital, the user cost of capital, and the wages given can lead to behavior by those households that leads to the Ramsey optimum. Okay, in that case, we can read the interest rate right off the chart. Okay, the interest rate in that model, in that economy, at every point in time, is the marginal product of capital less depreciation. And this is not, note the one is gone now because this is a continuous time model. Remember the Ramsey model, every second the interest rate is changing. Every second the agent is optimizing consumption. And every second the wages is changing depending what the capital stock is doing. So it's this huge system of stuff going on. And therefore we can act, unlike the OLG model, we have continuous measurement of the interest rate. Okay? So it's going to be a function of how productive capital is. That's the first term. It's a function of the depreciation rate. And at the Ramsey optimum, that's going to be equal to the social rate of preference, time preference, that was theta. That's also the private agent or household's rate of time preference, plus the population growth rate. These are all things we can measure. Okay, so in an economy where the economy is just reproducing like mad, you've got 3% growth, you'd expect the interest rate to be higher in that economy. If you had a very impatient economy where people just wanted to consume now, you'd expect the interest rate to be higher, and that's what the Ramsey model predicts. But it also predicts that in those economies, the marginal product of capital is important. So if capital is not very productive, or if the capital's productivity tapers off very quickly, you're not going to have very high interest rates. Okay, so these are all sort of implications that we can read off this equation, and especially because theta and n and delta are exogenous. And they're given to us by the model. So we basically can pick off, just like in the solo model, we can pick off the capital stock per capita that's associated with the steady state. Okay? So if you think about it, you know, even if you have technical change, it doesn't change much. It's just like the solar model. It'll add an extra wedge to the interest rate. We didn't do this in this class, but if you want, you can read about it in Benassi or any other books. Okay, so the real interest rate in this idealized economy is going to be a function of the last three parameters. Okay, so you've got the rate of technical change, and this is, we're talking about Herod-neutral, labor-augmenting technical change, theta, rate of impatience, and finally the rate of population growth. So those three things can change in the real world. We've seen them change. Okay, in the past 50 years, we've become less reproductive in Western European economies, in the United States. Theta, I don't know. People may or may not be less patient. I would think they'd become more patient, but that would mean lower theta. But let's just say people are the same. And delta, A, the rate of technical progress, is kind of, it's up for grabs. A lot of people think that we're moving into an age of stagnation. The kind of technical progress we see today involves computers, involves short-lived innovation that doesn't last very long. Think of Facebook. Facebook's already on the way out. It's not a commercial for Facebook, by the way. So, you know, if you think A is moving over time slowly, after the 1880s, we had a big increase in A because there were railroads and steel furnaces and the like, and then we moved into the plastic age and the automobile age. What do we have now? Okay, so all these things would speak for lower interest rates. So from a long-run perspective, like Ramsey, you'd expect interest rates to be lower now than they were, say, 5 decades ago, possibly 10 years ago. And there are a lot of serious economists who have appealed to that, okay? So instead of just saying it's all the ECB's fault, it might actually be a global thing. It might actually be a global phenomenon. The real interest rates are lower, and therefore we should think about that in those terms, okay? A second policy implication we might think about is Ricardian equivalence. This is basically how you treat your future tax liabilities. Ricardo, I mentioned this already, Ricardo had this idea that if the government cuts your taxes today and then raises your taxes in a year, what's that worth it to you? If you know that you have to pay those taxes yourself, you take the tax cut and put it in the bank, and then you can pay what the government's going to make you pay in 1 year's time. All right, so you can actually read that off the Ramsey model. It's a very robust implication that if taxes are non-distortionary, they don't affect agents' desire to consume or save or work at the margin, and if the government and the private sector actually use the same discount rates, the government doesn't have a financing advantage over the private sector, then it doesn't matter. The tax policy, people kind of see through the veil of tax cuts and tax increases. What matters is the present value. Okay, so if you think about it, it's easy to show this. This is a very general way of looking at it. If you think about the discount factor that you would use, you take, even though R is changing, you take some sort of average of that interest rate changing over time and use that to discount any future payment. So if I know that taxes are going to be cut in the future, and I'm thinking, well, that means kind of I'm more wealthy, but in the future, then I could actually borrow that money today and spend it now. But its value, its present value, would be lower because of the intermediating or interest rates in between. Okay, so this is just a little aside, and if you want to read, you can read more about that in Benassi. So this is two very interesting insights that are confirmed, and we already talked about Ricardian equivalence in the OLG model. Remember, we talked about the notion that maybe if the government cuts taxes today and just, commits to raising taxes tomorrow, it might not have any value if you think about your children and your children's liabilities. Okay, I'm done with the real economy for the time being. We're going to now talk about money. Okay, so this is kind of exciting, and the guy who just came in will not have missed anything because I'm just repeating myself, as always. Okay, so let's start with the basic question, like what are we talking about? What is money? So this is a fundamental question. And before I do that, I should ask if anyone knows in this room, which is getting less crowded, but still somewhat crowded, who that guy is. If you know it, just blurt it out. No extra points, but you'll get lots of grief from your fellow students. I'll give you a hint. He was from Scotland. Okay, nobody knows. David Hume. This dude was a philosopher who kind of dabbled in economics, a little bit like Ramsey. You know, this is kind of baby stuff. Math is harder, logic harder. So Hume was interested in philosophy, and he actually called. He wrote this treatise on money. It was very short, and it actually nails a bunch of points. This is a long time ago. This is like 1752. So this is what he wrote. He said, money is not one of the subjects of commerce, but the instrument that men and women have agreed upon to facilitate the exchange of one commodity for another. It is none of the wheels of trade. It is the oil which renders the motion of the wheels more smooth and easy. So he was looking at Spain, hitting it rich in Latin America and exploiting those countries, bringing all the gold back and looking at what was happening in the port of Cadiz. Cadiz was where the gold was being brought in, and looking what happened to prices of goods in terms of gold. So even though these people seemed to have lots of gold, the price of stuff that they cared about, like eating and drinking wine, those prices were going up in terms of gold. So the gold was losing value. And even though we like to look at it, you know, gold is pretty useless when it comes to like basic human needs. I mean, maybe wearing jewelry and stuff. But in the end, you can only wear a certain number of rings and jewelry, and you kind of run out. So the consumption value of gold is limited. So his idea was that even though Spain is getting all this gold, they're not really rich. It was a very interesting insight. It was a philosophical insight. He was saying, you know, because UK was always like competing with Spain. Like, God, those Spaniards are going to take all that gold from the poor, you know, Incas and Mayans and whatever, just bring it back. And then Hume said, well, maybe they're not really richer because they're just using it to trade for stuff they really care about. Okay? So this was a long time ago. And I think that's probably one of the deepest things we know about money is that it really doesn't matter. Okay, what matters is what you do with it. This is not like me talking as your parent, your mom and dad. It's just a fact. You know, I mean, it doesn't make sense to have a lot of cash under your pillow. It makes more sense to buy a car with it, or just give it to clean up the oceans, or buy a house or something. What matters is what you consume with it, or what you invest with it. Okay, so keep that in the back of your mind. That's going to come back as we look at money in terms of models. This guy, British economist, much later, thought maybe it might be useful to describe what money is, because people were kind of still battling with this. At the time, they were moving towards paper money. The introduction of paper money was kind of a new thing. In fact, the private sector was issuing banknotes, IOUs, and people were taking the IOUs and passing them around, right? Scottish banks were really good at this. That's why Scotland has such a reputation for being good with money, because they were ahead of the English in this sector. And the Scottish banks actually issued banknotes which were like highly senior debt on the balance sheet, so other banks could take over banks by just buying up all their banknotes. Right? It's kind of an interesting idea. And that would keep them honest. If you create too many banknotes, then of course you reduce the price and you get taken over. So it's a little bit like what we see today in stocks, in asset markets. So Jevons described money. He said it was a medium of exchange. His first observation, and this is something I memorized when I was in college. Okay, this is something that everybody learns for a macro course. But I mean, even though I'm not going to make you learn it, you might want to learn it. Because if you're at a cocktail party, sometimes it's useful. What do you learn in macro? Well, Jevons said, and that helps. So medium of exchange means something you can get what you want with. Okay, and there's the standard of payment. We agree. The first one's interesting because it means we basically solve the double coincidence of wants. You can be working in the computer sector. You may not know anybody who wants to buy your programming services, but you can, if you don't find somebody who gives you something with which you can buy what you want, you'll be in trouble. Okay, so that's the nice function of money. Standard of payment, we all agree. It leads to that situation. Store of value, this is more of an asset. I can hold money for a long time and then spend it. I can consume with it. And that's what we're going to focus on in a few minutes. And then there's a means of deferred payment. So I can write loan contracts denominated in this monetary unit. I can cut a deal with you. You give me 100 euros now, and I pay you 105 euros in 2 years' time or 1 year's time. Okay. So, and those are euros. We agree it's a standard of deferred payment. So you're not going to come and say, oh, those euros are different. They have a different serial number, or the UK just introduced new plastic money. I just discovered that last week. It's completely bizarre, but they still accept the old stuff. They won't accept my old pound coins, right? So that's interesting, right? Sometimes you're not going to be paying back your loans in coins, but if you wanted to, you'd be in trouble. You have to go to the Bank of England to get those exchanged. Okay, so does anybody know who this guy was? It's an American, of course. Any Americans out there? I know there are at least two. You guys know? Huh? Groucho Marx, not Karl, Groucho. Groucho Marx was one of the greatest comedians in America of the 20th century. And this guy was kind of like a vaudeville, but he went into movies and made really great movies. At the time, they were very funny, very successful. He also lost everything in the Wall Street crash. Completely lost his fortune. And then went back into movies and made more money because he was pretty talented. So Marx said, money frees you from doing everything you dislike. And since I don't like to do much, money is very handy. Okay, so the idea is that money has this transactions convenience function, which we're going to focus on. It's a dominated asset. You don't want to put your money under the pillow. You want to put your wealth in the bank, or maybe in a house or in a car. Or if you hold money, you're it's a disadvantaged store of value. It is a store of value, but it's dominated by other assets. Marx also said that, and I love this quote, you can't buy it doesn't make you happy, but it certainly allows you to be miserable any way you want. So using those super insightful quotations, I'm going to now try to make you understand why money matters. Okay, so there are many different ways to look at this, and many economists have focused on one, and they're all kind of different, and they're all kind of right. I'm going to focus on two. One is money as a medium of exchange, and the other is a store of value. Okay? And those are competing with each other. Those are competing. Okay? So if it's easy to get money, like if you work and you get paid in cash, you can always take the cash home and put it under your pillow or in a safe, and then later on you can spend it. So it's a means of transferring consumption from one period to the next, just like the capital stock in the diamond model. It's a way of moving consumption around through time. So that makes it compete with other assets. But obviously money has a disadvantage. It doesn't bear interest. As far as we know, even if you have a bank account that pays interest, it's not going to be very much compared with a longer term commitment or investment. So money is a dominated asset. It is an asset, but it's dominated by other forms, but it's also accepted as a means of payment. So it has this liquidity or transactions value. Transactions premium or liquidity premium, or there's all sorts of different ways to put it, but people will accept it, and that's a very fragile thing. Now think about that. The fact that you can go into a store and give them a piece of paper, or if you can go in China, you can go and pay with WeChat, the vendor has to agree. The vendor has to do what you ask, has to accept it. And have you ever tried to pay at Heathrow with Russian rubles? It's difficult, even though there are a lot of rich Russians in London. Okay, so it's easier to pay in dollars, not because there are a lot of rich Americans there, but just because it's more accepted. So it's really, this acceptance thing is very fragile. And that's one of the things that fascinates monetary economists. You know, the euro was introduced in 1999 and in cash in 2002, and people accepted it. Nobody said, I'm not going to touch that stuff. You know, maybe some people kept the D-marks, but fine, let them do that. But that means they're actually not using the means of payment that's accepted, because you take D-marks into that store over there, they won't take the D-marks unless they're, collectors. Okay, so the models we're going to sort of spin around and talk about, rotate, revolve around. There are 5 dominant models. We're only going to focus on 2, okay? But I just want you to know these things exist. The first notion is that you have to pay. Okay, so just by convention, people insist on seeing the money. They're not going to take a chunk of your house. They're not going to take your dog. If you want to buy something, they're going to take money. Okay, so that already narrows it down a little bit. Cash in advance. Okay, so this is not a credit model. These are cash in advance models. The second one is we've seen already. We saw the diamond model. Now we're going to put in money. And that's really neat. Okay, so you thought you were finished with the diamond model. Sorry. It gets even more interesting because you see immediately why the diamond model, the Samuelson model, because Samuelson invented it, or actually Allais invented it, but Samuelson wrote it down and got it published in an English-speaking journal. It's really about this acceptance, finding someone to take it. Who's the sucker who's going to take this piece of paper? Right? That's the most important insight about money. It's inherent. Fiat money, for the most part, has no outside material value, but it's accepted as a means of payment. You can also cheat, and you can put money in the utility function. So maybe I'll make some mention of that next week when we talk about, we finish up these ideas. Money in the utility function is used quite often, and that's a proxy for the liquidity services of money. So it's not, money kind of makes you happy, you know, in the sense that it makes your life easier. You don't have to run to the cash machine every time you want to buy something. Okay, you can keep it in your pocket. Or if you keep it in your bank account, you can use your bank account. Being able to use your bank account, even though no one can grab it, that's the convenience, the liquidity convenience, and the security convenience of money. Okay, you can think about money being in the budget constraint, like we did with diamond. So maybe there's some cost of that. You can also think of limited participation. Maybe the central bank is handing out money to certain agents in the economy, but you can't get it. The banks can get it, and then they can give you a loan denominated in that stuff. That's another fancy model that people have used in the past. It's not so popular now, but we'll focus on the first 2 for the time being. So I'm going to show you something practical now. This is one of my favorite charts or figures. This is the way you consolidate the holdings, the monetary and non-monetary holdings of the private sector and the central bank and the commercial bank. So we're basically taking the central bank as a big player because they're going to be important later on, very important. You're going to take the commercial banks as an aggregate, taking the balance sheets of all those entities and just putting them together in a single reporting. So any sort of intra-bank liabilities and assets will be canceled out. And then we take the public and the government and the households and just chunk them into one big balance sheet. This is all legitimate. If you can measure this stuff, accountants love this kind of stuff. And this is what you can find these data if you look in the IMF statistics. Okay, you can actually find these data. And this is simplified. There are a lot of complicated types of claims and liabilities and assets that we don't need to get into detail on. But the most important thing is you notice the central bank has assets. Central bank is this extra bank for the banks, and they have the monopoly on creation of the means of payment that we're going to be talking about in a second. And where does that show up in this picture? Okay, so it's like find the rectangle. Where is the money? Is the money an asset or a liability? So these are questions that masters should be able to answer. You should look at this, and even though you've been doing lots of math, you should be able to do this in a second. You should identify the rectangles that correspond to the assets that we call money, and for whom they're money, and for whom they're assets. Because it's, in this economy, everything is an asset and a liability. Almost everything. It's somebody's liability. Okay? Anybody want to give it a shot? Where's the money? Who wants to point to it? Okay, we're getting close because it's not the only I mean, it depends on what we're saying. It was just cash. If you look at the banknotes, it says nobody else can print those. So that is money, but is that exhaustive? Probably not. Depends on what you think money is, whether money is just cash, cash plus bank balances, liabilities of the banking sector. So it depends on whether you're talking about M1, M2, just currency, okay? Again, this is technical bureaucrat stuff, but it's important. If you want to track money and what's acceptable, you have to find it. So it's also the asset, it's a liability, it's also held by somebody. We'd like to think that it's held by the public, the non-bank public. Everything on the right-hand side are the agents that hold the money, and they consider it an asset. Okay, so there's the answer. Double entry bookkeeping, the left-hand side, the bank's liabilities, banknotes held by non-banks, and you find that right there. And here are the deposits. These are all not drawn to proportions, just to give you an idea of their relative qualitative size. Most money is actually not cash. Even in the United States, 90% is not cash. Most cash in America is actually not even in America. It's held by people in Latin America, Eastern Europe, Africa, blah, blah. Okay? Same thing is true of the euro. More and more cash is held abroad, not quite as much. And most of us are doing transactions with this stuff, which are created by the banks that are not government agencies. So the banks actually create money. They create money every time they lend. In the aggregate, they're creating money. And the only reason they're limited, as you remember from your macro course, is because the government is making sure the banks don't run away with the goodies. Okay, and there are all sorts of credibility issues, regulatory issues. Banks have to have a certain amount of net worth, capital in proportion to their assets. Okay, so when they make loans, they're able to create a deposit with themselves, and the deposit gets spent, and it comes back at some point. As an aggregate, the banking sector can't do nonsense, okay? So this thing can't just blow up infinitely, because it would be kind of, it would violate good banking practice and probably a lot of laws. But people use that stuff. So you and I mostly are spending our bank balances, our checking account, girokonto, to pay our rent, to get our money from our parents, or to pay for our vacation or something, pay for our BVG-Karte, right? You didn't pay that in cash. You probably used your card, which debited your account, which was right here. And that was your asset, their liability. So the banks are kind of important. They're creating this stuff that we have agreed to use, and it's fragile. We know from the Depression that when a few banks start to collapse, then other people get nervous about their banks, which might have been okay, and they take their money out. And when they take their money out, this starts to shrink, and the banks have to pay out in cash. That's the agreement. And I'm not going to get into that because you've learned about it in college, but that's kind of the exciting stuff. When we see banks collapsing, we all get really excited, right? Not good, but it's what crises are made of. Okay? So, assets and liabilities. Double entry bookkeeping. Now, we used to use gold. Gold is an outside asset. I mean, there's no... You can own the gold, but there's no liability associated with it. Isn't that interesting? And the same thing is kind of true of foreign assets. So if we own some D-marks and we're Americans, if we own some euros and we're Americans, those are kind of like liabilities of some other people from some other planet, but they still are liabilities. Ultimately, things like real estate, gold, those are real assets that are not monetary in nature. Okay, so the biggest volume of these balance sheets are basically monetary assets and liabilities. Well, keep that in mind. We'll come back to that later on in the course, because the central bank, as you see, has a big role to play in any sort of monetary system. Even if you don't have a well-developed banking system, the central bank is still pushing the means of payment into the economy. In a lot of developing countries, the central bank is making loans to the government, and the government is taking those loans and converting into cash and paying its employees. Okay, so that's one way of doing it. Or in more developed countries, the central bank may be lending money to the public through the commercial banks. Commercial banks may be marketing the bonds and maybe printing some money by issuing loans to the government. that are actually bonds that can be traded by the public. So there are all sorts of different models. In our world, it's the same thing. It's the ECB is not property of the Deutsche Bundesbank. Just a little piece of it is. So the German government can't really tell the ECB what to do. That's probably a good thing. But that's kind of a development that we've seen in many countries. In the United States, the Fed is independent of the government in principle, although the government could actually appoint someone else to be the chairman. Trump might get mad at Powell and say, I'm going to fire you. And actually, he can't do that, but he might tweet about him every day until he resigns. These are all, it shows you the tension between government and central bank. And it's going to lead to the things we're going to talk about right now, which is what happens when the government or the central bank creates money. Okay? So how do we do this? Let's start with the cash in advance approach. This is called the Cambridge equation, basically. The simple insight is if you have to buy Y goods and they cost P, then you may need M money to pay for it. Depending on the number of transactions per period, you need PY units of M. Okay? So obviously the period is important. What is a transaction? Is transaction equal to GDP? No, because if you have intermediate inputs, you might have many more transactions. You might be using money to swap art, buy artwork, or buy postage stamps that already exist. That wouldn't be GDP creation. It would be just kind of swapping assets. Okay, so all these things have to be considered. But take the most simple model where GDP is simply final purchases of goods and services. That's what it is. And that's PY. So this is the Cambridge equation. Basic high school economics. Okay, it's MV is the money supply, the stock, either an average or a point in time measurement, times V, which is called the money velocity, the velocity of money. Okay, it's the number of times per period that money gets spent on average. And on the right-hand side, we have GDP. Okay? Geldumlaufgeschwindigkeit is the German word. Okay? So the number of times in a unit period that the money is spent on average. Some money may not be spent at all. Some may be spent many times. Okay, this is an average. So it's just a definition. It's a tautology. V is a tautologically defined object. And the question is, for us, it's going to be interesting if velocity is kind of stable. Okay, so if people have a regular spending habit, if it's constant, which is not what we observe in the real world, but if it were constant, then we could actually invert this equation and write it like this. We could write a money demand equation which simply says money demand is GDP that's planned to be produced, basically scaled up by the velocity of money. Okay, so if velocity is high, the demand for money will be low. Remember, the demand for money is the amount of money at a point in time that you have in your pocket or in your bank account. So if you're spending it really quickly, it's not going to be much in your bank account. And if you're hoarding it, if V is very low, then you're going to have a big demand for money. So this is basic. This is to get you started. You have to understand this before you can understand anything else. Because I'm going to start manipulating this guy. If I think that V is stable, I can invert it in terms of P, and I have a price equation. I have basically a causal relationship between prices and money supply. Okay? So we have monetary neutrality. You let me assume the first part, and monetary neutrality is following by force of logic. So I can take logs of both sides. I can take logs of both sides of that equation and differentiate them with respect to time. So it's not just monetary neutrality, it's more than that. It's a statement about the inflation rate. The inflation rate is a function of monetary growth in the period, subtracting the quantity of money that would be needed just to finance a given real amount of transactions. Okay, so we have a theory of inflation. So the Cambridge equation delivers all sorts of stuff, bam, bam, bam. And for a long time, until the 1920s, people really believed this was it. There was no course in macro in 1920 at Chicago or Harvard or Cambridge. They had courses in money and banking because they thought this was sufficient. Okay, and under certain conditions, it might be sufficient. It's sufficient if velocity is stable. And Milton Friedman became very famous, claiming that it was stable. And we've seen that in the Depression it was not stable, and after the great financial crisis of 2008, 2009, it also was not stable. Okay, people started to hoard money. Okay, So the velocity of money went down. So these are things that the economics is supposed to help us explain. But to start, we need a working hypothesis, so we'll always start with monetary neutrality. In the long run, prices reflect the use of money in transactions and its quantity relative to each other. Okay, so that's a fairly robust statement. I'll show you some evidence that shows that it works. But remember, Hume at the beginning said the quantity of money doesn't matter. Okay, so he was talking about gold. And gold has alternative uses. You can use it, for jewelry. You can use it to plate old buildings, ceilings and roofs, and and embellish all sorts of things. Hume is basically saying it's the amount of goods and services that are produced are really what matters for economic well-being. And I do insist on that. It's a pretty smart insight that people forget all the time. So President Trump has forgotten it because he's pushing on Powell to increase the growth of credit and money and not raise interest rates. So, he just wants to get reelected, right? So if you look at the long run, the data support this. Okay, so countries, each one of those dots is a country. So the countries where the monetary rate of growth over several decades, here 40 plus years, is high, then you have lots of inflation. And where monetary growth is low, you have lower inflation. And this is a lot of countries. This is almost 170 countries. Okay, so you have obviously countries that are having civil war and having economic crises and all sorts of other things happening. Those can explain some of these outliers. You have a lot of countries that have really serious inflation, but monetary growth is kind of a necessary condition. And in the long run, it's going to be probably necessary and sufficient. You see the same thing in terms of exchange rate change. So countries that have high inflation, have high monetary growth, and also have a depreciating currency at the same time. So all these things kind of go together. Makes you think, okay, if the Argentine peso has lost 50% of its value since the beginning of the year, if the Turkish peso, the Turkish lira has lost 50% of its value, then unless things change, they're probably going to get some inflation. And, lo and behold, if you read the paper, that's kind of what's happening. Okay? It also holds for low inflation countries. This is the remarkable thing. So I take a microscope to that little corner, and you see this is just the OECD countries. And if you look at M1, which is cash in the hands of the public, plus checkable banking account balances, you see the growth of those things are also correlated with maybe not as tightly as you'd like, which underlies what I said before. Countries that grow in real terms will demand more money, have lower inflation, ceteris paribus. But still, it's interesting to see that of the OECD countries, the ones up here are the ones that have had high monetary growth, and here, the opposite. Okay, so enough of this introductory stuff. Let's go to our first model. Let's talk about the Samuelson precursor to the diamond model. Let's see if we can learn something from this setup, okay? So I told you already the French guy, Allais, actually anticipated this. He didn't write it down as clearly as Samuelson did, but Edmond Malenvaux, in a somewhat sarcastic essay in the 1980s, claimed that Allais had already said everything, he just didn't publish it in English. Okay, so we have to give the hat tip to Maurice Allais. In this model, fiat money is an asset because others believe that it's an asset. If they didn't, they wouldn't trade with you. If you had the money and you tried to get rid of it, they wouldn't accept it. And that's a key insight. So it's either trust, it's a belief. We're talking about an equilibrium that can be disturbed and possibly destroyed. And there's some interesting insights just from that. In this model, like in the diamond model, which didn't have money, there's a young generation and there's an old generation, and exchange is advantageous to both. And in the diamond model, the young were taking their income, taking part of it and using it to buy the existing capital stock from the old people who needed to eat and had nothing but capital to sell to the young people. So it was a perfect gains from trade. Pareto improving trade. Trade is good. Okay? Trade between generations. Now we have money. So money is not productive. It is completely useless. But it is the only way that young people can purchase goods to consume when they're old, because there's no capital in this model. So Samuelson stripped everything. It's like Robinson Crusoe with a bunch of young people and a bunch of old people. And the young people have the real goods, and they're going to be old next period, and the old people are gone, and they're going to look for someone that they can trade with. But the problem is, how are they going to contact young people that don't exist yet, who are going to be on the screen when they become old? So the young will use money as a vehicle to save, and just like the diamond model, but no productivity at all. So it's a way of accentuating this consumption smoothing motive of people. And the old people, of course, will use it, presuming that it has value when they become old. So the belief has to be realized, and if it's not, they probably may not believe it. Okay, so in the diamond model, we have utility, and in the Samuelson version of this, the OLG model of money, same thing. Okay, every generation alive at time t and young has a choice to allocate its income over the next 2 periods. Simple utility function with usual properties, and the population is growing. So there are more and more people coming on board. That's very important. Okay, so the economy as a whole actually has the means to smooth consumption. Okay, it has if someone could get their hands on the resources, the planner would certainly figure out a way to make everyone better off. If you rely on decentralized trade without money, you're going to starve. You're going to starve when you're old. You'll be able to eat like a king when you're young, and then you starve. Okay? If there's no productive capital, so it's not diamond, it's Samuelson, and you get the perishable, non-storable consumption good in the first period, you got to deal with that. Nothing in the second period. So this is really easy to understand. It's really to get your brain around. But I want to prove to you, beyond a shadow of a doubt, that autarky is a bad idea. So if you don't have money on this island, and you have the young people who keep washing on the shore, but they have stuff, and the older people have been there for one period and have nothing to eat, there's no reason, except for altruism, that the old people would get anything to eat. Maybe the young people feel sorry for them and give them something, right? But most people are not so nice. Okay? So just, if you don't get it, look at this picture. On the left-hand side, we have the individual budget constraint. It's just a dot. Okay? When I'm young, I get 1 unit of consumption goods, and then when I'm old, I get nothing. So I would be willing to pay a lot to be able to move some consumption into the future. Okay? For society, okay, for the planner on that island, he sees the young people washing ashore with their 1 coconut, and the old people are starving. He would just grab some of the old people's coconut and give it to the old people, and then he would say, hey, next time there's another generation coming in, I'll just take some of their coconut and give it to the old people. So the young people today won't feel like they've been ripped off, because they're actually getting something from the next generation. Right? Makes perfect sense. And that's the second plot. Okay, so using indifference curves, you can show, obviously, that if you're down here, you're not too happy. And if you can move anywhere up here, you're very happy. You're much happier. So society, if there were a central planner, would create this sort of sharing device and would take young people's stuff, not everything, take something and just give it to the next generation, to the older generation alive today, and continue to do that. And that's a Pareto improvement on the autarky. Okay, well, Samuelson's genius was to say that you don't need money. You don't need a central planner to do that. You just need money. You need something that people accept and would be able to spend, and hold, and use that to consume when old. Okay, but before I get there, I want to show you that even if you have a storage technology, okay, so suppose you could take the coconut that you have when you're young and put it in a hole somewhere. When you dig it up next period, it's kind of rotten, but it's still something. You can eat part of it. So you'd have like a rate of deterioration. It's still not Pareto efficient, because you could still, as long as the rate of population growth exceeds the rate of return on this negative rate of return on the storage technology, it makes sense to do some sort of transfer, and either with a central planner or to introduce money. So Samuelson talks about the social contrivance of money. His idea was that maybe, even before we started printing money with a central bank, maybe the use of gold or silver was seen as a way of transferring wealth. Also houses, okay? You want to transfer your consumption into the future. One of the biggest items of your consumption basket is your rent, your miete, right? Your cost of living in a place. So investing in a house and living it in the second period is a very intelligent way of moving resources without even using money. Using an asset that delivers some consumption when you're old. Okay, so this is a very general idea. In the diamond model, we had the same idea, except capital was used as this vehicle, and it was also productive. So it had a double whammy. We had the transfer of consumption, but we also had production over time. Okay, so now let's get into details. Now suppose the government just creates this stuff. It creates quantity H and doesn't change it. So you could think of this as gold, but think about it as money. It's even better because money doesn't have, the paper money doesn't have any utility value at all. Okay, so it prints H, and think of it as Bitcoin. Okay, you can think about Bitcoin. Bitcoin is growing because of mining, but maybe it won't grow much in the future, and who knows, but just suppose this is a fixed quantity. And it gives it to the old people today. Okay, so it's kind of a windfall for them because they thought they were starving, and now they get this check from the government, this cash from the government, and the government says, here, take this and see what you can do with it. And they say, well, maybe I can convince the young people how about this coconut to give me part of their coconut. And then they can use that money maybe if they believe. So we need the belief. We need the expectation that the value of the money is positive in the next period for these guys, and therefore the next generation will have the same expectation. In some sense, we can't believe that at some point in time money is going to be worthless. The price of goods will be infinite in terms of the monetary union, because then it would unravel. People would anticipate that, right? People would say, oh, I think at some future date, people aren't going to accept this, so I'm not going to accept it either. Okay. So the decentralized approach to this would let the household choose consumption today and tomorrow, when they're young and old respectively, to maximize the same utility function, but now they have a budget constraint that is terms of money. And T is the price of the consumption good in terms of this paper money. Okay, so the household's decision is to basically choose C1T and basically sell the residual to the old people and use that money, put it under their pillow, and pay for goods in the second period using that stuff. So the only difference is PT. PT will change, and PT plus 1 may be different from PT, and therefore the household has to kind of anticipate, if it wants to do things the right way, what the rate of deflation or inflation is going to be in that setup. Okay, so it's really simple. The model has survived for 60 years, right? We're about to celebrate its 60th birthday of publication. You know, and this is one of the reasons Samuelson got the Nobel Prize. And Samuelson was a super mind. I mean, he did lots of stuff. You can find this in any advanced macroeconomics textbook. It delivers insights on environmental protection. I already told you that. Growth theory, all sorts of other things. You can think of BADS, pollution. Okay, so let's push that a little bit further and ask what's next. Okay, so if the price is not infinite, okay, if the price of the goods in terms of money is not so high that it can't even be written down, it will have some value to the young, because it gives them some opportunity to transfer that consumption. If you don't have any goods in the second period, you're not very happy. You're going to get lots of gain of trading intertemporally, and that's a very important insight in macro. We know that, right? People like to smooth consumption, and that's an artifact of almost all the assumptions we make in macro. Okay? Okay, so the first order condition for that maximization problem, which is simple, you don't have to use Lagrange, just plug it in, see what happens. It looks like this. So basically, the marginal utility of consumption today relative to the price of goods in terms of the monetary union, that ratio is equal to the same ratio tomorrow discounted by my rate of impatience. That's beta, okay? That looks pretty simple, doesn't it? I mean, we know basically that consumption is the only thing you can do in this economy. There's no investment in goods. You just get the 1 unit of the good, and you can eat CT of that, C1T, and then the rest of it you sell, and then it goes into the second period, and depending on how much purchasing power your money has in that period. So given your expectations of PT, the profile, or the time, intertemporal profile, or time path of PT, you will plan your consumption accordingly. Okay? So, if PT is stable, then you're going to be behaving a little bit like the diamond model. But if PT is not stable, then you may change your behavior a little bit. You can think about it. If you think money is going to be worth less in the second period, PT is high, then the margin utility of your consumption is going to be high in the second period because you're consuming less. You're scaling back consumption because if you try to transfer money into that period when PT is high, you're not going to get much anyway, so let's move it into the present. Okay, so it's like the way people behave when inflation's going up. People get really nervous and start spending their money like mad. It's exactly what you have in this. This implies a demand for money. Okay, so this is one of the rudimentary derivations of a demand function for money. Money is going to depend on the rate of interest, the rate of return on holding money. And that's just the ratio of PT plus 1 to PT. Okay, so PT plus 1 over PT, or PT over PT plus 1, whichever way you want to cut it. If it's greater than 1, you have inflation in the former case, and you have deflation in the latter case. Okay, so that's and you can have deflation. Japan, they had deflation for like 10 years. So prices can be falling, right? Kind of makes you want to save because the TV is going to be cheaper in 5 years. Just put the money in the bank or put the money under your pillow. And I know Japanese people who've told me that they do this, right? And they get bonuses that actually go down over time because they don't need, the logic is, well, you don't need that money because everything's cheaper now. So there's this interesting logic of deflation. It's kind of scary because there's uncertainty in the world, et cetera. Anyway, that's the money demand function. First cut. Okay, so we have real money demand. Now, why is that? It's because to buy that consumption, I need, you have to go back to the budget constraint and plug in your optimal choice of CT given PT. Implies a certain demand for money, MT, and that's going to be a function of what you expect the future to happen to PT. PT divided by PT plus 1. So think of this as the rate of deflation. If PT plus 1 is less than PT, that's going to be like a rate of return, a gross rate of return, 1 plus something, on money. So usually people don't want to hold money because you can go to the bank and get better rate of return. You can put it in the stock market. If the prices are falling, then money becomes really competitive, right? So it becomes like a real contender for asset holding. So this is just the first cut of the diamond model would actually predict, I'll just tell you right now, if you have positive population growth, more and more people coming on board, and everyone still gets 1 unit of consumption, prices are probably going to be tending downward over time. Okay, we'll look at that. We'll see. We can talk about, inflation or deflation. You just have to subtract 1 to make it the inflation rate that you recognize. It's just a ratio of prices. So if you go out and calculate this, you can do it right now and go to the website and see what the price of goods in Germany has been doing recently. Mostly it's going up, but recently the inflation rate's so low, we've had several quarters of deflation. But people don't usually talk about deflation unless it's really sustained, like many quarters in a row, like in Japan or like in some Scandinavian countries, and also in Germany after the financial crisis. Okay, so let's push this a little bit harder. I'm going to push it harder now. I'm going to try to get some steady state implications. I'm not going to do dynamics because it's hard, and it's also not really the model of choice. I mean, it's not. I'm just giving you a little taste of what you could be doing for the rest of your life, or maybe never again. I want you to learn just the ideas, okay? But remember, the demand for money is still a savings function in this model because that's the value of the money. Money is a store of value. It's a means of transforming consumption today into consumption tomorrow. So as a savings function, it looks just like the diamond story. You have a substitution effect. If the rate of deflation goes up, you're going to hold more money, but you feel richer, so you'll maybe hold less because you want to spend and not save. So we don't really know a priori the sign of that derivative, but usually it's going to be positive. Okay, the substitution effect dominates. Okay, you can put it on its head, which means when inflation goes, if inflation is positive, and you can't have inflation yet, but if we do have inflation, you can see that it goes up, people hold less money. People don't want to hold money if the value of their money in terms of goods is going down, and they want to hold it even less if that money is losing value at a faster rate. Okay, so money is a hot potato. This is a nice way of putting it because a lot of people still it's hard to get your head around this. We have a constant supply of money. People don't get any utility from holding it. They just have it because when they're young, they need it so they can eat when they're old. It could be seashells. It could be, gold. This could be a monetary. It doesn't have to be a central bank with paper money. It could be H could be anything that people accept and no other people accept as a means of payment. So it could be Bitcoin, anything you want. As long as there's a finite price in the future, people will accept it because they think there's a chance and they have some expectation, which is correct in this model, that they'll be able to spend it when they get old. Okay? Obviously, if the price of money goes to infinity when they're old, then why should they bother touching it? Really key insight. Okay, so we can push it some more. The market, there are two markets here. You've got a market for goods and a market for money. And there's this thing in microeconomics called Walras law. There's an apostrophe after the S. Walras was a very famous economist. I think he was Swiss, but he spoke French. And it was about markets clearing. If n-1 markets clear, then the nth market must also clear. So that applies in this case. Okay, for that reason, we can define a money market equilibrium, supply equals demand. And supply equals demand in every period as we move through time. What is the supply of money? Well, the old guys are holding H, and they're going to look to spend it. Okay? Okay, when they spend it, they're also supplying it. Okay, spending means they buy consumption, they supply to get the money out into circulation because they were holding it. Okay, so H divided by PT is the real supply of money in period T, and the demand by the young people. Okay, you've got H. You have to remember this is like people are growing, so you have NT plus 1 every period. The demand for money will depend not only on the rate of deflation, but also depend on how many people there are in that period. Okay. And then you've got an equilibrium. So the equilibrium is simple. We can write it for T plus 1. It's going to hold in every period. And we can take a ratio of those last two equations. H cancels. Okay, all that's happening is there are more people, but in effect, there's more demand. As long as n is positive, you're going to have more and more people coming on demanding more money, so they're going to have a natural pressure to raise the demand for money. For demand for money to equal supply, the price is going to have to fall, okay, to make the money more valuable because it's not increasing in quantity. So in the stripped down baseline version of this model, constant supply of money that's printed, it's got gold fringes on it, can't be counterfeited, made of plastic, that sort of thing. You have this natural implication. Okay, so this is true for any t equals 0, 1, 2, 3, 4. Okay, so you've got basically a kind of a contest between population growth and deflation relative to the rate of change of money demand, or the relative change of money demand. Now, if you think about it, if we want to focus on steady states, we want to focus on steady states where the rate of deflation is not changing. So the rate of inflation or the rate of deflation isn't changing. These two guys cancel. The right-hand side cancels, and all we have basically is population growth and the rate of change of prices. Okay, so this model has a really robust implication. If things are stable, the right hand is constant is equal to 1, then the rate of deflation is related to the rate of pressure on money demand coming from population growth. And you can use your mind to expand a little bit what that means for other things. I mean, if the economy is growing, you're going to have even more deflation, right? Because the economy is growing because of population growth. We know from our Solo model that population growth, technological progress, all these things can contribute to more and more demand, goods and services being produced, and that would lead to more money demand. And that's kind of the logic that comes in later. We'll see. Okay, we'll talk about it in a second. There it is. Okay, so as long as n is positive, PT plus 1 has to be less than PT. So we have a natural deflation in this economy. Okay, as the economy is getting bigger and bigger in real terms, the price level has to be falling. And there's a natural incentive for the government to maybe it's a good idea to increase the money supply at a certain rate because maybe it'll make us popular. In this model, it doesn't matter. People don't get any utility from inflation, but there might be a temptation to do that. If a government could come on and just say, look, I'm going to give you guys a raise. If you vote for me, here it is. And the next government does the same thing. There's all sorts of temptations for governments to take advantage of this monopoly power to create money. It's not in the model, but everyone always asks, well, why would the government want to increase H? Why don't we just leave H the way it is, right? If everyone accepts it. Well, there's all sorts of interesting ideas. I'm just going to take as a given that the rate of monetary growth may not be 0, and it's probably not going to be negative. We know that the contrivance of money is a good idea. So maybe there are people out, I mean, my best guess for this is that maybe there's inequality and the government wants to help the people who have less, so give them some money. Okay? It's not in the model. We still have to ask the hard question, why does the government do this? Okay? So I'll let you figure that one out. So the price level falls, or the inflation rate, negatively expressed, is equal to negative n. Okay, so in this crazy model, if n is negative, if the population is shrinking, like in Japan, ceteris paribus, you'd get inflation, right? It's kind of interesting thought. Don't want to think about it too much, but we have situations where this might be happening. So this model has been used to think about house prices in a demographically challenged country, right? I mean, everybody wants to live in Berlin now. That's probably one good reason why the price of real estate is going up finally after all these years. But in Germany in general, not so obvious, okay? The United States is going through a demographic transition as well. Japan has much more of a demographic transition, so you'd expect that to affect the real value of all assets. But in a world where there are no other assets, there's just this money, you'd actually have an intriguing implication, because there's fewer and fewer people driving the demand for money. You can use this model to think about gold, Bitcoin, houses, and other stuff. You just got to get the other parameters right? That's kind of the, and it is one model that people use to think about cryptocurrencies. Okay, it's a little bit complicated because there isn't a single issuer, right? You have to think about mining and free entry. You can all start a coin. Just take a course in it, get the code. It's online. But to get inflation, money supply has to increase in this model. Okay, so that's the first insight we're going to drive home now. I'm going to derive that result, and then we'll be done. I hope this has convinced you that the OLG model is useful. It's a useful way of thinking about a lot of things. Okay, so let's push it. I just want to remind you that a necessary condition for an equilibrium to exist is that the economy lives forever. In other words, if you had a terminal condition, if we knew the world was coming to an end in 2020, and in that year money is worthless, it would make no sense for the people who are young today to even consider if it's a perfectly correctly anticipated path for prices. And they would anticipate that the next generation won't do it, and therefore it will have no value today. The price of goods would be infinite today. So it's kind of it's an unraveling. It's a loss of confidence in the model. Now remember, the world is not certain. So in a world of certainty, this is easy to show. But in a world of uncertainty, you have to have an assumption about the mean and the variance and the distribution and probability distribution, whether it's constant, whether it's changing. But if the young people lose faith in the money, they're not going to buy it. And that's pretty easy to understand. That's why Zimbabwe had the hyperinflation, okay? And they tried to introduce a new money and people wouldn't accept it. And now they've got more inflation again because people just didn't accept it. As soon as they got it, they tried to spend it. So the young in this model don't buy into the idea that the money's going to have value when they're old, they're not going to take it. And the equilibrium is a bad equilibrium. So there's an equilibrium in this model where money has positive value and it works as a social contrivance to smooth consumption. And there's an equilibrium where it's worthless. T equals 0 to infinity. Okay? And this is a model with perfect foresight. Okay? Now, even if you have storage, it's still a good idea. Okay? So as long as the storage technology does not have a productivity that's higher than the rate of deflation in this economy. Okay, so if money is not yielding an interest rate, a yield of a rate of return that's higher than the productivity of the storage technology, I'm not talking about capital, I'm talking about storage. So if you put the coconut in the hole and you dig it up the next time, it's half edible and the rest you have to throw away. Okay, the problem would arise that still gives you a social value of the social contrivance of money. Okay, you can still do better than even just putting everyone digging their own little hole and putting it away. Kind of logical, right? But as soon as the coconut starts to grow, and then you get, a rate of return on your coconut equal to R, cap R as a gross rate, then actually there may be no use for money, okay? Because then you can use the coconut as a means of intertemporal substitution, okay? So then it becomes like capital. So as long as that's a typo, I think. As long as R is less than, no, that's right. If R is greater than N, so in this perverse case where the coconut starts growing, then there's no monetary equilibrium. People never even bother with money because it's not useful to them. They can transfer their consumption into the second period by just planting the coconut or putting it in some storage that's growing. So now let's get into the interesting part. Now the government gets the idea, I'm going to give money to the old people. And I'm going to give lots of money to them. Okay, I'm going to give new cash. So even a model where there's this intertemporal trade, maybe the government says, well, the poor old people, just give them a little bit of extra money. See what happens. Okay, and we're going to call that mu. So mu is the gross, it's the net rate of growth of money. So 1 plus mu is what they actually get. They have MT and they get mu t times MT, or mu t plus 1 times MT, so they have 1 plus mu t plus 1 times MT. So they have more than they gained for it. And it's a transfer, so that they don't have to do anything for it. Maybe it's a retirement plan or something. So when you're young, you know that, and you plan for that. But you have to have an anticipation of what the price level is going to be given the new policy of the government. So we're solving for an equilibrium that is consistent with individual maximizing behavior. The household, when young, chooses consumption today and consumption tomorrow to maximize utility like before, but now it gets this little extra kick in the second period. It saved using MD, but when it comes to time to spend the money, they actually get a little bit extra. They get this mu t plus 1. Okay, so this is the transfer that makes it all go. And mu t is t plus 1 for all t is exogenous and is chosen by the government. The government chooses that, and I can't influence it, in this model. Okay, so then the first order condition for utility maximization is the same, except now the price might be changing its behavior a little bit now that we've got this injection of money that's giving the old people a bit more purchasing power. Now in this model, there are flexible prices, so the prices clear the market. More money chasing the same goods means higher prices. So obviously, the inflation rate will not be the same as before. It won't be a deflation rate under certain circumstances. The money demand function is already different. Okay, so now it depends on two things. It depends on the rate of return on money. That's the deflation rate, that's the first part. And the second argument is the transfer in real terms. What is the real value of the goodies the government is passing? So the government's giving you mu t plus 1 on top. Think of that as your income, your retirement income, but it's only valuable to the extent that pt plus 1 is not infinite. Okay, so pt plus 1 has some value. That's going to influence the value of the transfer you get in that period. Okay, so you can think of money demand having two arguments. It depends on its rate of return, and it depends on the real income that you get. And the more you think you're going to get in the future, the more money you're going to demand today. Okay, makes sense. It's like your income. Just like you'd think from Robinson Crusoe getting coconuts in the future. Okay, so we do the same trick. If we have a steady state where the rate of growth of money is constant, the rate of growth of inflation, or the rate of growth of prices is constant, and money demand is unchanging, then this ratio takes on magical properties. The right-hand side becomes constant. It becomes equal to 1. Okay, and there should be the extra argument I forgot to put in. Okay, but this thing just turns into 1 because the rate is the same by construction, by assumption. So the right-hand side has to adjust, right? The gross rate of inflation, the gross population development, and the gross evolution of the money supply have to combine in some way to yield a constant. Okay, and this comes because of the inflation of purchasing power, the increasing demand, and this is an artifact of the population evolution. So n is positive in the analysis we have. So if you multiply this out and simplify, okay, remember if pi is small and n is small, the product is close to 0. So as an approximation, we can just write the following. Money and inflation interact with population growth to fulfill that condition. Okay? So inflation is a function of monetary growth. This is the steady state. Everything's constant. Net of the population growth, which we know has a deflationary impact on this OLG model. And of course, that can be a proxy for economic growth in general. So we've kind of come full circle. If you put money in the diamond model, you get the same type of outcome. It's tricky because, as I said before, money can be dominated by the productive asset. So you have to give people some reason to hold the money, but that's not so difficult. So inflation is approximately equal to the rate of growth of the money supply less the growth rate of the economy or the population, the exogenous growth of money demand. So money, the price of money, or the price of goods in terms of money. Okay, so always think of that. The price level is the price of goods in terms of money. You can also think about it as the price of money in terms of goods. That thing is going to be a race between the supply and the demand. That's a fundamental insight from monetary economics that we get from the OLG model. So what have we learned today? We've learned basically that an OLG model can transform worthless paper into something that people value because they expect other people to value it when it comes time to spend it. All right, so that gives you a lot of interesting insights into the next step. The next step would be to ask what happens when other things influence the demand for money? And secondly, what influences the government to create money? Is it just the government? Or could it be the banking system? Could the banking system also be creating money through its creation of credit and extension of credit to the private sector, the household and corporate sector? All these things are important, but to explain those pictures that we had at the beginning of the lecture with persistent differences in inflation rates, we really have only recourse to the rate of growth of money. Argentina doesn't have a shrinking population. Argentina doesn't have a super collapsing economy. Maybe it does now, but over the past 50 years, it's all about money. And it's not because its banking sector has been creating credit in a way that's excessive or inconsistent with good banking practice. It's not the case at all. It's the case that the government has created through its monopoly on the purchasing power, has created too much at a consistently higher rate than in other countries. So in the next lecture, we'll try to explore why that would be the case. Why would the government do that? Well, one reason might be because it cannot raise taxes to pay for its expenditures. And it has to borrow money from the central bank. The central bank is the last instance. Okay, that's an easy one to understand. You understand that. You understand all the hyperinflations of the past 100 years, especially after World War II, but also the Weimar inflation, 1920 to 1922. So these are really easy things to grasp. They're obviously not the whole story. You might also think that there are political reasons. Maybe governments have problems controlling their transfer policies, spending money not just on defense and wars and other things, but there might also be a political problem, transferring money to certain groups using this kind of mechanism we discussed before to create continuous transfer of resources to people who do not contribute to the productivity. Because if they did, if the economy grows faster, that creates a deflationary tendency. Okay? Okay. So this has been a real pleasure to change gears, and I hope you come back next week. We talk about money in more detail. Thank you. I want you to learn just the ideas, okay? But remember, the demand for money is still a savings function in this model because that's the value of the money. Money is a store of value. It's a means of transforming consumption today into consumption tomorrow. So as a savings function, it looks just like the diamond story. You have a substitution effect. If the rate of deflation goes up, you're going to hold more money, but you feel richer, so you'll maybe hold less because you want to spend and not save. So we don't really know a priori the sign of that derivative, but usually it's going to be positive. Okay, the substitution effect dominates. Okay, you can put it on its head, which means when inflation goes, if inflation is positive, and you can't have inflation yet, but if we do have inflation, you can see that it goes up, people hold less money. People don't want to hold money if the value of their money in terms of goods is going down, and they want to hold it even less if that money is losing value at a faster rate. Okay, so money is a hot potato. This is a nice way of putting it because a lot of people still it's hard to get your head around this. We have a constant supply of money. People don't get any utility from holding it. They just have it because when they're young, they need it so they can eat when they're old. It could be seashells, It could be, gold. This could be a monetary. It doesn't have to be a central bank with paper money. It could be H could be anything that people accept, and no other people accept as a means of payment. So it could be Bitcoin, anything you want, as long as there's a finite price in the future. People will accept it because they think there's a chance, and they have some expectation, which is correct in this model, that they'll be able to spend it when they get old. Okay? Obviously, if the price of money goes to infinity when they're old, then why should they bother touching it? Really key insight. Okay, so we can push it some more. The market, there are two markets here. You've got a market for goods and a market for money. And there's this thing in Macroeconomics called Walras law. There's an apostrophe after the S. Walras was a very famous economist. I think he was Swiss, but he spoke French. And it was about markets clearing. If n-1 markets clear, then the nth market must also clear. So that applies in this case. Okay, for that reason, we can define a money market equilibrium, supply equals demand. And supply equals demand in every period as we move through time. What is the supply of money? Well, the old guys are holding H, and they're going to look to spend it. Okay? Okay, when they spend it, they're also supplying it. Okay, spending means they buy consumption, they supply to get the money out into circulation because they were holding it. Okay, so H divided by PT is the real supply of money in period T, and the demand by the young people. Okay, you've got H. You have to remember this is like people are growing, so you have NT plus 1 every period. The demand for money will depend not only on the rate of deflation, but also depend on how many people there are in that period. Okay? And then you've got an equilibrium. So the equilibrium is simple. We can write it for T plus 1. It's going to hold in every period. And we can take a ratio of those last two equations. H cancels. Okay, all that's happening is there are more people, but in effect, there's more demand. As long as n is positive, you're going to have more and more people coming on demanding more money, so they're going to have a natural pressure to raise the demand for money. For demand for money to equal supply, the price is going to have to fall, okay, to make the money more valuable because it's not increasing in quantity. So in the stripped down baseline version of this model, constant supply of money that's printed, it's got gold fringes on it, can't be counterfeited, made of plastic, that sort of thing. You have this natural implication. Okay, so this is true for any t equals 0, 1, 2, 3, 4. Okay, so you've got basically a kind of a contest between population growth and deflation relative to the rate of change of money demand, or the relative change of money demand. Now, if you think about it, if we want to focus on steady states, we want to focus on steady states where the rate of deflation is not changing. So the rate of inflation or the rate of deflation isn't changing. These two guys cancel. The right-hand side cancels, and all we have basically is population growth and the rate of change of prices. Okay, so this model has a really robust implication. If things are stable, the right hand is constant is equal to 1, then the rate of deflation is related to the rate of pressure on money demand coming from population growth. And you can use your mind to expand a little bit what that means for other things. I mean, if the economy is growing, you're going to have even more deflation, right? Because the economy is growing because of population growth. We know from our Solo model that population growth, technological progress, all these things can contribute to more and more demand, goods and services being produced, and that would lead to more money demand. And that's kind of the logic that comes in later. We'll see. Okay, we'll talk about it in a second. There it is. Okay, so as long as n is positive, PT plus 1 has to be less than PT. So we have a natural deflation in this economy. Okay, as the economy is getting bigger and bigger in real terms, the price level has to be falling. And there's a natural incentive for the government to maybe it's a good idea to increase the money supply at a certain rate because maybe it'll make us popular In this model, it doesn't matter. People don't get any utility from inflation, but there might be a temptation to do that. If a government could come on and just say, look, I'm going to give you guys a raise. If you vote for me, here it is. And the next government does the same thing. There's all sorts of temptations for governments to take advantage of this monopoly power to create money. It's not in the model, but everyone always asks, well, why would the government increase H? Why don't we just leave H the way it is, right? If everyone accepts it. Well, there's all sorts of interesting ideas. I'm just going to take as a given that the rate of monetary growth may not be zero, and it's probably not going to be negative. We know that the contrivance of money is a good idea. So maybe there are people out, my best guess for this is that maybe there's inequality and the government wants to help the people who have less, so give them some money. Okay? It's not in the model. We still have to ask the hard question, why does the government do this? Okay? So I'll let you figure that one out. So the price level falls, or the inflation rate, negatively expressed, is equal to negative n. Okay, so in this crazy model, if n is negative, if the population is shrinking, like in Japan, ceteris paribus, you'd get inflation, right? It's kind of interesting thought. Don't want to think about it too much, but we have situations where this might be happening. So this model has been used to think about house prices in a demographically challenged country, right? Everybody wants to live in Berlin now. That's probably one good reason why the price of real estate is going up finally after all these years. But in Germany in general, not so obvious, okay? The United States is going through a demographic transition as well. Japan has much more of a demographic transition, so you'd expect that to affect the real value of all assets. But in a world where there are no other assets, there's just this money, you'd actually have an intriguing implication, because there's fewer and fewer people driving the demand for money. You can use this model to think about gold, Bitcoin, houses, and other stuff. You just got to get the other parameters right? That's kind of the, and it is one model that people use to think about cryptocurrencies. Okay, it's a little bit complicated because there isn't a single issuer, right? You have to think about mining and free entry. You can all start a coin. Just take a course in it, get the code. It's online. But to get inflation, money supply has to increase in this model. Okay, so that's the first insight we're going to drive home now. I'm going to derive that result, and then we'll be done. I hope this has convinced you that the OLG model is useful. It's a useful way of thinking about a lot of things. Okay, so let's push it. I just want to remind you that a necessary condition for an equilibrium to exist is that the economy lives forever. In other words, if you had a terminal condition, if we knew the world was coming to an end in 2020, and in that year money is worthless, it would make no sense for the people who are young today to even consider if it's a perfectly correctly anticipated path for prices. And they would anticipate that the next generation won't do it, and therefore it will have no value today. The price of goods would be infinite today. So it's an unraveling. It's a loss of confidence in the model. Now remember, the world is not certain. So in a world of certainty, this is easy to show. But in a world of uncertainty, you have to have an assumption about the mean and the variance and the distribution and probability distribution, whether it's constant, whether it's changing. But if the young people lose faith in the money, they're not going to buy it. And that's pretty easy to understand. That's why Zimbabwe had the hyperinflation, okay? And they tried to introduce a new money and people wouldn't accept it. And now they've got more inflation again because people just didn't accept it. As soon as they got it, they tried to spend it. So the young in this model don't buy into the idea that the money's going to have value when they're old. They're not going to take it. And the equilibrium is a bad equilibrium. So there's an equilibrium in this model where money has positive value and it works as a social contrivance to smooth consumption. And there's an equilibrium where it's worthless. T equals 0 to infinity. Okay? And this is a model with perfect foresight. Okay? Now, even if you have storage, it's still a good idea. Okay, so as long as the storage technology does not have a productivity that's higher than the rate of deflation in this economy. Okay, so if money is not yielding an interest rate, a yield of a rate of return that's higher than the productivity of the storage technology, I'm not talking about capital, I'm talking about storage. So if you put the coconut in the hole and you dig it up the next time, it's half edible and the rest you have to throw away. Okay, the problem would arise that still gives you a social value of the social contrivance of money. Okay, you can still do better than even just putting everyone digging their own little hole and putting it away. Kind of logical, right? But as soon as the coconut starts to grow, and then you get a rate of return on your coconut equal to R, cap R as a gross rate, then actually there may be no use for money. Okay, because then you can use the coconut as a means of intertemporal substitution. Okay, so then it becomes like capital. So as long as that's a typo, I think. As long as R is less than, no, that's right. If R is greater than N, so in this perverse case where the coconut starts growing, then there's no monetary equilibrium. People never even bother with money because it's not useful to them. They can transfer their consumption into the second period by just planting the coconut or putting it in some storage that's growing. So now let's get into the interesting part. Now the government gets the idea, I'm going to give money to the old people, and I'm going to give lots of money to them. Okay, I'm going to give new cash. So even a model where there's this intertemporal trade, maybe the government says, well, the poor old people, just give them a little bit of extra money. See what happens. Okay, and we're going to call that mu. So mu is the gross, it's the net rate of growth of money. So 1 plus mu is what they actually get. They have MT and they get mu t times MT, or mu t plus 1 times MT, so they have 1 plus mu t plus 1 times MT. So they have more than they gained for it. And it's a transfer, so that you don't have to do anything for it. Maybe it's a retirement plan or something. So when you're young, you know that, and you plan for that. But you have to have an anticipation of what the price level is going to be given the new policy of the government. So we're solving for an equilibrium that is consistent with individual maximizing behavior. The household, when young, chooses consumption today and consumption tomorrow to maximize utility like before, but now it gets this little extra kick in the second period. It saved using MD, but when it comes to time to spend the money, they actually get a little bit extra. They get this mu t plus 1. Okay, so this is the transfer that makes it all go. And mu t is t plus 1 for all t is exogenous and it's chosen by the government. The government chooses that, and I can't influence it, in this model. Okay, so then the first order condition for utility maximization is the same, except now the price might be changing its behavior a little bit now that we've got this injection of money that's giving the old people a little bit more purchasing power. Now in this model, there are flexible prices, so the prices clear the market. More money chasing the same goods means higher prices. So obviously the inflation rate will not be the same as before. It won't be a deflation rate under certain circumstances. The money demand function is already different. Okay, so now it depends on two things. It depends on the rate of return on money. That's the deflation rate, that's the first part. And the second argument is the transfer in real terms. What is the real value of the goodies the government is passing? So the government's giving you mu t plus 1 on top. Think of that as your income, your retirement income, but it's only valuable to the extent that pt plus 1 is not infinite. Okay, so pt plus 1 has some value. That's going to influence the value of the transfer you get in that period. Okay, so you can think of money demand having two arguments. It depends on its rate of return, and it depends on the real income that you get. And the more you think you're going to get in the future, the more money you're going to demand today. Okay, makes sense. It's like your income. Just like you'd think from Robinson Crusoe getting coconuts in the future. Okay, so we do the same trick. if we have a steady state where the rate of growth of money is constant, the rate of growth of inflation, or the rate of growth of prices is constant, and money demand is unchanging, then this ratio takes on magical properties. The right-hand side becomes constant, it becomes equal to 1. Okay, and there should be the extra argument I forgot to put in, okay, but this thing just turns into 1 because the rate is the same by construction, by assumption. So the right-hand side has to adjust, right? The gross rate of inflation, the gross population development, and the gross evolution of the money supply have to combine in some way to yield a constant. Okay, and this comes because of the inflation of purchasing power, the increasing demand, and this is an artifact of the population evolution. So n is positive in the analysis we have. So if you multiply this out and simplify, okay, remember if pi is small and n is small, the product is close to 0. So as an approximation, we can just write the following. Money and inflation interact with population growth to fulfill that condition. Okay? So inflation is a function of monetary growth. This is the steady state. Everything's constant. Net of the population growth, which we know has a deflationary impact on this OLG model. And of course, that can be a proxy for economic growth in general. So we've kind of come full circle. If you put money in the diamond model, you get the same type of outcome. It's tricky because, as I said before, money can be dominated by the productive asset. So you have to give people some reason to hold the money, but that's not so difficult. So inflation is approximately equal to the rate of growth of the money supply less the growth rate of the economy or the population, the exogenous growth of money demand. So money, the price of money, or the price of goods in terms of money. Okay, so always think of that. The price level is the price of goods in terms of money. You can also think about it as the price of money in terms of goods. That thing is going to be a race between the supply and the demand. That's a fundamental insight from monetary economics that we get from the OLG model. So what have we learned today? We've learned basically that an OLG model can transform worthless paper into something that people value because they expect other people to value it when it comes time to spend it. All right, so that gives you a lot of interesting insights into the next step. The next step would be to ask what happens when other things influence the demand for money? And secondly, what influences the government to create money? Is it just the government? Or could it be the banking system? Could the banking system also be creating money through its creation of credit and extension of credit to the private sector, the household and corporate sector? All these things are important, but to explain those pictures that we had at the beginning of the lecture with persistent differences in inflation rates, we really have only recourse to the rate of growth of money. Argentina doesn't have a shrinking population. Argentina doesn't have a super collapsing economy. Maybe it does now, but over the past 50 years, it's all about money. And it's not because its banking sector has been creating credit in a way that's excessive or inconsistent with good banking practice. Actually, it's not the case at all. It's a case that the government has created, through its monopoly on the purchasing power, has created too much at a consistently higher rate than in other countries. So in the next lecture, we'll try to explore why that would be the case. Why would the government do that? Well, one reason might be because it cannot raise taxes to pay for its expenditures. And it has to borrow money from the central bank. The central bank is the last instance. Okay, that's an easy one to understand. You understand that. You understand all the hyperinflations of the past 100 years, especially after World War II, but also the Weimar inflation, 1920 to 1922. So these are really easy things to grasp. They're obviously not the whole story. You might also think that there are political reasons. Maybe governments have problems controlling their There are transfer policies, spending money not just on defense and wars and other things, but there might also be a political problem, transferring money to certain groups using this kind of mechanism we discussed before to create continuous transfer of resources to people who do not contribute to the productivity. Because if they did, if the economy grows faster, that creates a deflationary tendency. Okay? Okay. So this has been a real pleasure to change gears, and I hope you come back next week. We talk about money in more detail. Thank you.